Good afternoon. My name is Jesse Colombo. I'm an analyst here at Real Investment Advice and Clarity Financial, and today I'm going to be discussing several complacency indicators that confirm my assertion that we're in a dangerous economic bubble. And starting out, I want to discuss the high yield or junk bond spread. And you can see that's on the chart that I have right over here, where you can see this is the differential of the yield between junk bonds and an index such as U.S. Treasuries, a much safer type of investment. And you can see when the spread is very wide, that's typically what happens during a financial crisis like in 2008, where junk bond yields are much higher than Treasury yields. And it's because investors are selling off junk bonds because they're very risky and they don't want to hold them during a financial crisis, and that's what causes that differential to jump. But during an economic bubble, you'll see the spread tighten up quite a bit, like what we have currently, what I call the everything bubble since 2008, 2009. You saw the same phenomenon back 10 years ago during the housing bubble. And you also saw a similar phenomenon back in the late 90s during the dot-com bubble. So what happens is, during a bubble, investors become complacent. They're no longer concerned about risk, and their fixation is earning a profit. They don't care about risk. So that's where we are right now. That's why you have these spreads are so low. And I know many people are going to try to write off and say, oh, this time is different. I don't believe it's any different. I believe it's showing the same pattern and indicating the same type of sentiment that we saw in prior Fed-driven bubbles. And the Fed creates complacency. In addition, you can see other complacency indicators are telling the same story, like the VIX or the volatility index. It measures fear of U.S. investors. And you can see during a financial crisis like in 2008, fear spiked. Whereas right now, fear is very low. And that's what you typically see during a bubble. Fear is extremely low, remains there for a very long time. More so in a market that's manipulated by the Fed. The Fed holds interest rates low and backstops the market and creates this environment of complacency. That's why the volatility is so low. I'm just concerned that it's going to follow the same pattern that it did 10, 12 years ago, where that low volatility turns into high volatility when the financial markets come back down to earth again. And you can see my next chart over here is the St. Louis Fed Financial Stress Index. And I know the junk bond or high yield spread and the VIX are components of this financial stress index among 16 other components, but still I figured it's worthwhile to show over here because it just paints the same picture. You just see this period of low volatility and low fear, which shows that investors are extremely complacent. And you saw the same thing 10 years ago during the housing bubble. And I'm worried that we're heading for another spike like we saw in 2008 once this current complacency bubble ends. And on this chart, you can see this is the U.S. Fed funds rate. This is really the source of the complacency. This is behind everything. All the complacency is the Fed. By holding interest rates so low, they're backstopping the market and essentially telling investors that they're going to be there if the market falls. The Fed will ease and send the market back up again. So you can see what's happening here is interest rates have been at record lows for a record period of time since early 2009, late 2008 during the financial crisis. We've held rates at record low. Even though they've been rising over the last 2 years, they're still extremely low. If you compare it to the prior cycle, like what we saw in 2005, 2006, we're still at very low rates. So I believe that a bubble's forming because of these low rates, similar to what happened in the last cycle, and then also similar to what happened during the dot-com bubble. Every time you have these troughs or lows in interest rates, that's when a bubble forms. And you can see these record low interest rates being held at record lows for a record period of time, is why the U.S. stock market has been soaring so much with nary a pullback for 8 or 9 years. And the longer rates remain low, the longer the stock market's going to continue bubbling up and inflating. But eventually this bubble is going to burst and it's going to result in serious pain. And you can see in this next chart I have over here, this is valuations for the U.S. stock market for the S&P 500. And you can see we're about as overvalued as we were in 1929. And we are the most overvalued we've been since the dot-com bubble. So either way you look at it, the market is extremely overvalued. This is really direct result of the Fed pumping so much money into the system, and I just unfortunately don't believe it's going to end well. Please take a look at the rest of my report on realinvestmentadvice.com, where there's more detail than I discussed today. Thank you for watching.